Most Americans won't retire, they'll just get old and broke. This isn't about some future market crash. The disaster has already started, and it's hiding in your monthly bills right now. In a few minutes, I'll show you why even people who did everything right are still ending up in poverty, and what a small group of retirees are doing differently while everyone else sleeps. The big lie, the retirement dream you were sold. You were sold a script that sounded simple. Go to school, get a job, buy a house, contribute to your 401k, and retire at 65 with dignity and security. That story actually worked for your parents' generation because the system was fundamentally different back then. Pensions existed, and companies took care of employees for life. Houses cost 3 times your annual income instead of 8 times. Healthcare didn't bankrupt families. College didn't require 6 figures of debt. But somewhere between their generation and yours, the deal changed completely, while the promise stayed the same. You were told to follow the same path your parents took, except every single element of that path became exponentially more expensive while your earning power stagnated. The script kept telling you to save, invest, and plan. But the underlying math shifted so drastically that following the old playbook became a guarantee of failure rather than success. The wealth transfer happened gradually enough that most people didn't notice until it was too late. Corporate profits soared while employee benefits vanished. Pension plans disappeared, replaced by 401ks that shifted all the risk from employers onto workers. Stock buybacks enriched shareholders while wages remained flat for decades. The entire architecture of retirement security was quietly dismantled and rebuilt to benefit everyone except the people who actually needed it. Meanwhile, financial advisors kept selling the same dream, pretending the foundation hadn't crumbled beneath your feet. They kept saying save 10%, contribute to your match, diversify your portfolio, as if those tactics could somehow compensate for a system designed to extract wealth rather than build it. What makes this betrayal even deeper is that inflation systematically eroded purchasing power faster than wage increases could compensate. Between 1980 and 2024, the cost of housing increased by over 400%, while real wages for middle-class workers grew only about 20%. Your parents could afford a house on a single income with a high school diploma. Today, dual-income households with college degrees struggle to qualify for mortgages. The economic foundation literally shifted beneath an entire generation, yet the cultural narrative pretended nothing had changed. Financial institutions profited enormously from this shift, selling refinancing schemes, home equity loans, and credit products to bridge the gap between income and expenses, turning what should have been stable wealth building into a debt trap. Here's the gut punch stat that reveals the scope of this disaster. Most Americans will retire with less than $50,000 in total savings. Some studies show the median retirement savings for people approaching retirement age sits around $45,000. That's not enough for 2 years of basic living expenses, let alone 20 or 30 years of retirement. The system promised security but delivered just enough to survive maybe a couple of years before your money runs out and you're left with nothing but one government check that arrives monthly. And that check, the one almost everyone is counting on, is where the math gets truly frightening because almost no one has actually sat down and calculated whether that check covers their real expenses. That's the trap most people don't see until it's too late, when they're already 65 or 70, and the check hits their bank account and they realize for the first time that the numbers don't add up. But by then, there's no time left to fix it. So let me show you exactly what that check looks like and why it keeps you poor instead of keeping you secure. Social Security exposed. The check that keeps you poor. The average Social Security check as of December 2025 is $1,959 per month. That's what decades of working and paying into the system gets you. $23,500 per year. Let me build you a budget using that check and you tell me if this works. Average rent in America is $1,700 monthly. Your Social Security check is $1,959. After rent, you have $259 left for the entire month. But you're not done paying for shelter. Utilities run another $150 to $200. You're now down to about $60. Groceries for one person cost minimum $300 to $400 monthly if you're buying the cheap stuff. You're already $400 negative, and we haven't touched gas, car insurance, phone, internet, clothing, or any other basic necessity. And here's where it gets cruel. That math assumes you own your home outright or you're renting. If you still have a mortgage at retirement, you're completely underwater immediately. The check doesn't cover your housing payment plus anything else. You're going into debt every single month just to exist. Let me show you this visually. 1959 comes in, 1700 goes to rent, 150 goes to utilities, 400 goes to food, 80 goes to car insurance, 60 goes to gas, 50 goes to phone. That's $24.40 in basic expenses against $19.59 in income. You're negative $481 monthly before healthcare, before prescriptions, before anything breaks, before any emergency of any kind. The Social Security Administration's own data reveals that nearly 40% of retirees rely on Social Security for at least 90% of their income. These aren't outliers, they're the norm. What's particularly devastating is that Social Security was never designed to be anyone's primary income source. It was meant as supplementary income alongside pensions and personal savings. But with pensions extinct and savings depleted, Social Security became the entire safety net by default. The annual cost of living adjustments sound protective until you realize they're calculated using metrics that don't reflect retiree spending patterns. The calculation emphasizes consumer goods while underweighting healthcare and housing, the two categories eating up most of retirees' budgets. You're not lazy, you're not stupid. You were handed an equation that never added up in the first place. The Social Security system was designed when life expectancy was shorter, when people had pensions supplementing their income, when houses were affordable, and when healthcare didn't cost what it costs today. Every one of those assumptions is now obsolete, but the check amount hasn't caught up to reality. And even if you somehow survive on that check by cutting every possible expense, eating less, living in cheaper housing, skipping anything that isn't absolutely mandatory, there's one bill you can't outrun. It's the bill that shows up precisely when you're at your weakest, when you have no earning power left, when your savings are already depleted, and that bill is the one that finally breaks most retirees, no matter how careful they were with money their entire lives. The healthcare ambush, the bill that shows up when you're weakest. Most people think Medicare means free healthcare. That myth destroys more retirees financially than almost any other misconception. Medicare is not free. Medicare Part B, which covers doctor visits and outpatient care, costs a premium. For most people, that's about $175 monthly in 2025, deducted automatically from your Social Security check. Medicare Part D for prescription drugs costs another premium averaging about $50 monthly. You're already paying $225 monthly just for the premiums before you receive any care. But premiums are just the beginning. Medicare has deductibles. Part A, hospital coverage, has a $1,600 deductible per benefit period. Part B has a $240 annual deductible. Then there are co-pays and coinsurance for every service. 20% coinsurance on most outpatient services means you're paying 20% of every bill out of pocket. A $10,000 surgery means you're paying $2,000. Prescription drugs have their own separate co-pays that vary by tier. And here's the killer that nobody explains until you're already enrolled. Medicare doesn't cover long-term care. If you need a nursing home or in-home care because you can't live independently anymore, Medicare pays almost nothing. Long-term care costs $60,000 to $100,000 annually. Your $1959 monthly Social Security check covers approximately 2 months of nursing home care before you're completely broke. The Medicare Advantage plans that insurance companies aggressively market as superior alternatives often create their own nightmare scenarios. These plans can deny coverage for services that original Medicare would cover, require prior authorizations that delay urgent care, and impose restrictive provider networks that limit where you can receive treatment. Dental, vision, and hearing coverage gaps represent another ambush, services that deteriorate with age but remain almost entirely out-of-pocket expenses. A set of dentures costs $3,000 to $5,000. Hearing aids run $2,000 to $6,000 per ear. Cataract surgery with premium lenses can exceed $5,000 per eye after insurance. Let me give you a composite story that happens thousands of times every year across America. A couple retires with $40,000 saved, both receiving Social Security. They budget carefully, they live modestly, everything works for 2 years. Then, one of them has a stroke. Hospital bills arrive, rehab is needed, recovery is slow. Medicare covers some costs, but the 20% coinsurance on a $60,000 hospital stay is $12,000. Half their savings disappear immediately. The stroke leaves lasting effects requiring ongoing care. They need help at home because the person can't be left alone safely. Home healthcare costs $4,000 monthly. Medicare covers some visits, but not the daily help they actually need. They're now spending $4,000 monthly from savings plus whatever Social Security doesn't cover from other expenses. Their $40,000 in savings lasts about 8 months before it's gone. Then they're living purely on Social Security with zero buffer, and the medical expenses haven't stopped. That's the healthcare ambush. It doesn't matter how carefully you saved. One major illness wipes out everything because the costs are designed to exceed what normal people can afford. Medical bills stack up like physical weight, literally burying your Social Security card under paper, crushing any security you thought you had. But here's what makes this even worse. Even if you somehow dodge the medical bullet for a while, even if you stay healthy longer than most, there's another cost quietly rising under your feet every single year. It's a cost that many people thought they'd escaped entirely, but they didn't escape it. They just paid off one piece of it while the rest kept growing. The housing trap, when paid off, still means you're not free. A paid-off home used to mean freedom. For your parents' generation, burning the mortgage meant they were done paying for shelter. But that's another lie that survives because people want to believe it. Let me show you what a paid-off home actually costs in 2025. Property taxes keep rising because local governments need revenue, and homeowners are captive taxpayers. You can't move your house. You can't hide it. The tax bill arrives annually, and if you don't pay, they take the house eventually. Property taxes in many areas run $1,500 to $3,000 annually. In high-tax states like New Jersey, Texas, or California, property taxes can hit $6,000 to $10,000 annually on a median-priced home. That's $500 to $800 monthly, even though you own the house outright. And here's what makes property taxes particularly vicious for retirees. The assessments keep climbing based on market values, even though your income is fixed. Your neighbor sells their house for $50,000 more than comparable homes sold for last year. Now, the county reassesses your property at that higher value. Your tax bill jumps 8 to 12% in 1 year. Your Social Security cost of living adjustment gave you maybe 3%. You're losing ground annually on a house you own outright simply because other people are buying and selling around you at higher prices. Some states offer property tax freezes or caps for seniors, but the requirements are strict and the relief is limited. You might get your assessment frozen at current levels, but that doesn't help if you moved into the house recently when values were already inflated. And many states offer no senior protection at all. The tax bill just keeps climbing regardless of your age or income situation. Homeowners insurance has exploded in cost, particularly in states facing climate risks. Florida homeowners are paying $5,000 to $8,000 annually for insurance. Texas coastal areas are similar. California fire zones are seeing massive increases or complete loss of coverage. Even in lower risk states, insurance runs $1,200 to $2,400 annually. That's another $100 to $600 monthly. Insurance companies are pulling out of entire states or drastically limiting coverage. When your insurer drops you, finding replacement coverage means going to the state's insurer of last resort at significantly higher premiums with worse coverage. You thought you were safe with insurance, then you get a non-renewal notice and discover your only option costs double what you were paying before. Climate change has introduced a new variable that retirement calculators never anticipated. Homes in previously safe areas now face flooding, wildfire, or hurricane risks that didn't exist when you bought the property decades ago. Insurance companies are using sophisticated climate modeling to identify properties they consider too risky to insure profitably. This leaves longtime homeowners trapped. They can't sell because buyers can't get affordable insurance, and they can't afford the skyrocketing premiums. Some retirees are discovering their home, which they assumed was their primary retirement asset, has become an unsellable liability. The equity they counted on to fund their retirement is locked inside a house nobody wants to buy. Then, there's maintenance and repairs. Roofs need replacement every 15 to 20 years at $10,000 to $20,000. HVAC systems fail, water heaters break, plumbing leaks, electrical issues happen, foundation problems emerge. A realistic maintenance budget for an older home is $2,000 to $5,000 annually. You can defer some repairs for a while, but eventually things break that can't be ignored. The cruelty is that houses deteriorate faster when you're older and less able to maintain them yourself. Tasks you used to do yourself, like painting, minor repairs, yard work, now require hiring help. A simple gutter cleaning that you used to do with a ladder now costs $200 to hire someone because you can't safely climb ladders anymore. Every maintenance task becomes more expensive when you can't do it yourself. HOA fees in many communities run $200 to $500 monthly and increase annually. Utilities keep rising: water, sewer, trash, electricity, gas, internet. Even being conservative, utilities run $200 to $300 monthly. If you're in a hot climate running air conditioning or a cold climate running heat, utility costs spike even higher. Add it all up: property taxes $4,000 annually, insurance $2,000 annually, maintenance $3,000 annually, HOA fees $3,600 annually, utilities $2,800 annually. That's $16,400 per year, or $1,367 per month. And that's before your mortgage payment, which doesn't exist anymore because you paid off the house. Your $1,959 monthly Social Security check minus $1,367 for the house leaves you $592 for food, gas, car costs, healthcare, clothing, phone, and everything else. And remember, we already calculated that food alone is $300 to $400 monthly. You're negative again. You thought you escaped the system by paying off your house. The system moved into your house with you, wearing different disguises called taxes, insurance, and maintenance instead of a mortgage payment. So what happens when the Social Security check doesn't cover the house, the food, and the doctor? That's when millions of quote-unquote retired Americans quietly go back to work. Because they don't have a choice. Retirement isn't a reward anymore. It's a luxury that only wealthy people can afford. Everyone else just gets old and keeps working until their body physically gives out. Work until you drop, the new normal. Drive through any American town and look at who's working retail jobs: baggers at grocery stores, greeters at Walmart, cashiers at fast food chains. Many of them are in their 60s, 70s, even 80s. These aren't people working for fun or to stay busy. These are people working because Social Security doesn't cover their bills and they have no other option. The gig economy markets itself as flexibility and side hustles, but for millions of seniors, it's survival. Driving for Uber or DoorDash when you're 70 isn't a choice. It's desperation. Your body hurts, your reflexes aren't what they used to be, you're exhausted. But the bills keep coming and the Social Security check keeps falling short, so you drive strangers around or deliver food in your own car, burning your own gas, hoping you make enough to cover the gap between income and expenses. Labor force participation rates for workers over 65 have been climbing steadily for 2 decades, reversing a century-long trend of earlier retirement. Bureau of Labor Statistics data shows nearly 19% of Americans 65 and older were working in 2024, the highest rate since the early 1960s. But here's the distinction that matters: most aren't working high-paying professional jobs. They're working physical, low-wage positions that offer no benefits and provide no path to improving their situation. These jobs offer just enough income to delay complete financial collapse, but not enough to ever rebuild savings or escape the cycle. And the shame that comes with this is crushing. These are people who worked 40 years, they raised families, they paid taxes, they did everything society told them to do, and now they're asking their adult children for money to cover rent or prescriptions. That psychological weight, the embarrassment of admitting you failed at retirement, destroys people emotionally in ways that compound the physical exhaustion of still working. There's a fear that grips people when they realize they can't actually stop working. It's the fear of checking the mailbox and finding another bill they can't pay. The fear of their car breaking down and not having money to fix it. The fear of choosing between medication and food. This isn't theoretical poverty. This is millions of Americans living it right now. And the exhaustion isn't just physical. It's the exhaustion of working when your body is actively failing. When your knees hurt standing for 8-hour shifts. When your back aches from lifting boxes. When your hands shake from arthritis, but you still have to operate a cash register. Your body is telling you to stop, but your bank account is telling you that stopping means homelessness or starvation. If this feels like where you're heading, understand. This isn't an individual failure. You didn't fail. The system failed you. The promise was broken long before you realized you'd been lied to. This isn't about you being bad with money or lazy or making poor choices. This is a national setup where the majority of people were handed a game they couldn't possibly win, and then blamed for losing. But here's the thing nobody talks about. While most Americans are stuck in this trap, grinding away at jobs that hurt their bodies just to barely survive, there's a small but growing group of retirees who looked at this broken system and said no. They refused to play the game. They refused to accept that 60 years of work earns you poverty and pain. And what they did instead is so simple that most people don't even consider it an option. The people who refuse to retire into poverty, most Americans will retire in poverty because they're playing a game that was never meant for them to win. The math doesn't work. Social Security doesn't cover basic expenses. Healthcare bankrupts you. Housing costs never stop even when the mortgage ends. And you end up working until your body quits because you have no other choice. That's the reality for tens of millions of people right now. But not everyone is accepting that fate. The International Living Global Retirement Index tracks exactly where retirees are finding better value for their fixed incomes. What they've discovered challenges everything Americans assume about retirement. Countries with universal healthcare systems eliminate the medical bankruptcy risk entirely. Nations with lower costs of living stretch that same Social Security check 3 to 4 times further. Places with favorable residency programs for retirees actively welcome Americans seeking affordable dignity in their later years. These aren't desperate moves to dangerous countries. These are calculated relocations to stable nations where the economic fundamentals favor retirees instead of exploiting them. Some retirees looked at this broken math and made a different choice. They decided, if I can't fix the system, I'll change the playing field. They moved to places where their fixed income still buys dignity, healthcare that won't bankrupt them, and an actual life instead of just survival. They took their Social Security check, the same $1959 that doesn't work in America, and moved it somewhere the math actually adds up. I broke down 5 of those places in another video. 5 countries retirees are escaping to right now, so they don't end up in exactly the nightmare I just showed you. These aren't vacation spots. These are places where your Social Security check covers rent, food, healthcare, and you actually have money left over. Places where being retired doesn't mean being poor. If you watch this far, you already know the truth about retirement in America. You've seen the real numbers. You understand the trap. The next step is seeing what the people who refuse to retire into poverty are actually doing, where they're going, how much it costs, what the real trade-offs are. Click that video on your screen, the one about the 5 countries retirees are escaping to. Don't just sit with the fear. Go see what the alternatives actually look like.